Hello and welcome to the Relax It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell here with Pete Belcastro. We've missed you, Pete, but now the gang is all back together.
That's right. We're getting him back in. He's got to get his reps back in.
Okay.
That's right. Missed you too, Wendy.
So what are we going to be talking about today, guys?
Taylor Swift. Just got that in. Hashtag Taylor Swift off the table there. For listeners you missed, we had a lot of banter back and forth before we actually got on. But today we're going to talk about the shifting concerns of investors. For the past 2 years, inflation has been the primary focus of investors. A big concern, for investors around the market overall. A lot of that has been, based on what the Fed is prescribing, interest rate decisions, and when inflation might stabilize or start to slow down. Investors
Has it already done that?
It has slowed down, and that's why we're starting to see a shift in the focus. I think a common misconception that I always like to frame is inflation slowing doesn't mean prices go back to where they used to be. It just means they're not climbing as quickly.
Yeah. They will never really go back to where they were, correct?
Hopefully not. That's actually a really bad sign for the economy if everything goes down. If we have deflation, that's a different concern.
Oh, okay. What about corporate greed? No, I'm just kidding.
Yeah.
Well, that's a whole separate podcast, too.
You get a little too much time together, I think. Okay. Proceed.
I think really when you get down to it, it is, can we have a slowing economy? Can we reduce inflation without going into a recession? Like you said, we see some deflation. You could really see the stock market take a tank. So when we talk about a recession, that's two negative quarters, consecutive quarters of negative GDP. So we're talking about things going down. We're talking about your investments going down, and maybe postponing retirement, making people feel uncomfortable. A lot of things could really be affected by a downturn of the market. So, typically whenever you start cutting interest rates, that's what tends to happen. So, whenever we do see that that the Fed is finally in a place to start reducing the interest rates, what's that going to do to the stock market? So, I think we mentioned that inflation peaked back in 2022 at over 9%. So, the price of everything was really, taken off. And like we talked about, we're still feeling it today, even though inflation is back down to about 2.5%. So it doesn't make us feel any better when we're still paying, a lot, at the grocery store, at the gas pump, and it doesn't make people feel any better, if I tell you that, long-term inflation is over 2.5%, it's around 2.75, or we even consider like 3%, Josh?
Yeah, 110, I think close to 110-year average is a little over 3, like 3.1. So, yeah, we had a lot of really low, and in order to get to an average, we need something higher, right? We got very used to very low inflation, where the increase in prices was not really very noticeable. Inflation as a whole, Wendy, we talked last episode about eggs and your recent shopping experience and the frustration in the increase of the price of eggs. Some items will always peak in prices, others might slow down. I think we've seen the trend with technology that although iPhones now cost like $1 million with the latest upgrade that they just added another camera and another useless feature, the price of technology as a whole has become a lot cheaper over the last 15 years as well. So certain things in that basket of goods are going to shift differently. What we're talking about here is not your price of eggs or the price of an iPhone, but really what the average consumer is buying as a whole. How is that impacted? and it has been quite high. I think there's those extreme stories that we hear: lumber prices for a period in time, uh, eggs, chicken wings, all kinds of different pieces of the sector were pretty newsworthy at times. But overall, inflation, the general rise of goods, has been quite high. It is leveling out now, and I think that's why we have these discussions from the Fed.
Well, and may I just throw in there that you had mentioned, we had all gotten kind of used to low inflation. We had all gotten used to low interest rates as well, which is another thing that will likely not come down again as low as we had been seeing it, right?
Yeah, I wish. I think it's going to move with the Fed. I mean, I think we'll have. Uh, there has been one of the things to combat that we saw even prior to interest rates going substantially higher was the increase in online banks. So separate divisions or separate entities that don't have a nice brick building on every corner, and somehow they can give you more yield on your investments. But ultimately, a bank is using short-term rates, making a little bit of money off the top and giving you the excess. They're going to have to move with those rates. Now, in this higher interest rate environment, they're able to be a little bit more competitive, depending on the bank, to give you more. But I think that will shift as the Fed lowers rates. We'd expect savings rates to go down, kind of in step with that over time.
And I think nobody believes that these rates are going to be high for a long period of time, which is why we see this inverted yield curve. I think there's been a lot of talk of recession. At the beginning of the year, gosh, it was almost like an 85% chance we're going to have a recession. The Fed's going to raise interest rates 20 times, well, I think it was 6, but still, we're here in September, and there hasn't been one decrease in interest rates. We finally did see some volatility in the market in September. We saw things kind of tank in manufacturing. So we saw the entire stock market pull back, even though this only happened in manufacturing, which only makes up, a small portion of our economy, about 20%. Really, we are a service economy. So that makes up about 70% of our GDP, or what we bring in. And that is still strong. We're still resilient. So even though there's, in the media, in the news, they start to kind of build, brick by brick, this wall, just another brick in the wall here, to building like a big wall of worry. And oftentimes people run into this wall, and it keeps them from looking further in the future. And what we've seen is evidence that the market tends to climb over that wall of worry.
Yeah, I think I think Morgan Housel talks about in some of his books that, the biggest risk we have, we don't know, right? And what tends to happen with the media, or even trying to project economic figures, is, well, that gets priced into the market pretty quickly, right? I mean, the Fed cutting rates, which right now looks like it's gonna happen, right? Maybe by the time this is released, it has already happened. But a lot of that gets priced into the market right away. It's only when there's a surprise that things change. If we think about the biggest things that have actually impacted the market over the last group of years, it's quick interest rate rises and COVID-19. Well, they raised interest rates because in COVID-19, we flooded everything with cash. So go figure. Inflation went higher. So now we've been kind of going through, if you're on the lending side, the pain of getting this back under control. If you're a retiree, I don't see a problem with the environment we've been in. Maybe you've had that big increase in the cost of goods, but you're actually making some money on your savings account. I mean, with savings accounts yielding over 5%, that's crazy. That has never occurred in my life. As the Fed is lowering rates, we'll see that readjust. But I think that's it. A lot of the focus is now, hey, inflation's calmed. What's the Fed going to do? What's the impact to the economy? And as Pete had mentioned, whether it's manufacturing or concerns with the labor market, these are factors that the Fed is also watching as they're lowering rates. but the market's watching as well. This wall of worry, or the idea that there's all these bricks in the wall, as Pete said, is kind of building that, might cause short-term volatility in the market as well, right? It can build up. There's all these concerns that maybe aren't going to drastically impact the economy, but in the short term, the market can be worried, and people trade based on that.
Yeah, we see those fluctuations, and it, like we said, it's based on headlines, and the market in all is a forward-looking indicator. So, a lot of these things that we're experiencing, like we said today, with a potential rate decrease, the market's already priced that in, like in our own lives, I think it's something like 85% of the things that we worry about never come to fruition. So I think that's that's a lot of the times that is true in the stock market as well. A lot of the things that people say, we're going to a recession, or the world's ending. A lot of those things are really they don't tend to happen. Maybe it's more than 85% even.
Yeah, I think we talked about this in the last episode too, right? We worry about shark attacks, but deer cause more issue.
Yeah, there you go.
Don't say deers, though. If you say deers, the whole thing's thrown off here.
Because that's not proper. That's not what they're
It's
called.
deer. I know.
Right. Okay. So, what's been going on this month then when it comes to things happening and going on?
I like that. That's going to be Bloomberg report there. What's the happenings going on? I like it. So inflation is continuing. So we saw a 0.2% increase last month in inflation, year over year, 2.5%. So that represents 5 months now of inflation cooling off. So the trend is pretty stable now. It doesn't appear like that's going to shift quickly. We never know, right? Crystal ball's only so clear. But that's part of these changes that we're seeing here. Any short-term deviation from that, the Fed's likely to not overreact to. I think now, as we've been talking about, the shift is more to these economic factors. How's the impact now that they are talking about lowering rates? Can we monitor this closely to make sure we don't cause a problem?
Yeah, absolutely. And I mean, as the Fed, starts to scale back that interest rate. We're also seeing some regulatory changes for banks. The capital requirements for banks, they're actually decreasing. The Fed, they're making their changes, and the banks are lobbying to decrease some of these capital requirements. So we do see, that might be. Obviously, this is only impacting the larger banks, but that's another positive for the economy. That's another that's going to make it easier for banks to do business. So, that's reducing some of these fears and negative economic impacts as well. So we're starting to see some things that are indicating that this economy is still strong enough that even if rates go down, we might not get pushed into a recession. We might not need that for prices to get normalized, to get back within the range we think they should be.
Yeah, I think Pete and I were kind of laughing about that. The object was to propose stricter regulations on banks, but it didn't quite happen that way. That is typically a sign. If we look at when the banks get stricter regulations, it's after the mortgage crisis. Or, it's kind of after they get in trouble, after it affects the economy. Okay, now we're going to put the clamp down on them. So the idea that regulations are lower is, however much we want to laugh about how ridiculous it is a good sign for the economy. That, they're not pushing down on those regulations at this time.
Yeah, it's obviously banks make if they could charge more interest, they make more. So they are So sometimes, the perception is with rates dropping, these banks aren't going to make as much money. And pretty much what we're saying is that that's pretty much going to be maybe a net zero or even maybe a net positive for banks, even while interest rates are going down.
Yep. So, I mean, it puts them in a good position. I think the other thing that we wanted to make sure we talk about a little bit is the yield curve. I think for years we've been told, when the yield curve is inverted, that means we're it's a recession predictor, right? We're expecting a recession to happen. In English, the yield curve being inverted means that if you tie up money for a longer period of time, you're not getting paid incrementally more than if you tied it up for a shorter period of time. And we've seen that for a while now, right? Banks, you might see billboards or anything else that are advertising, hey, 11-month, 12-month, 13-month CD, 5%, 3-year CD, 3%. Well, wait, why do I make less money if I tie it up for longer? Well, the banks are saying, we don't think these interest rates are going to stay here forever, right? So we're not willing to guarantee the money for an extended period of time. Some of that, and it's predicted here, if the Fed starts lowering rates, that'll start to levelize. The yield curve will start to become more normal over time. But the market, banks, all these different institutions don't believe that 5% interest rates are going to sustain forever. So I think that the idea that predicts a recession, at least in this current environment, has not been true. I think rather we might see it jump around a little bit, and it might become an economic indicator again here once rates normalize over the long term. We think about through COVID, interest rates went from like zero and skyrocketed really quick to help combat inflation. So I think it caused an abnormal environment.
That's right. Remember this, that the market, it's always a forward-looking indicator. Whether it's inflation, it's growth. The key is to remain focused. We like to pay attention to long-term trends, nothing that's short-term. So we look for the long-term trend, long-term opportunities, and and the best thing we can do is really just try and stay informed, stay calm when these things happen, and keep climbing that wall of worry. Don't get stopped by it.
Yep. Just dismantle it.
That's
one
right.
brick at a time. I think another one that we all often do as people, and it's not maybe necessarily market driven, but it's similar, is we say we should have, right? And there's one business coach that I've listened to over the years, and he often says, quit shoulding all over yourself, right? Like, don't keep saying I should have, right? You didn't. Let's move on, right? And I think that's it. Sometimes we're so fearful of certain things that we paralyze ourselves. There's always going to be a worry in the market, and you know what? If it's in the news, it might already be priced in. So we can certainly monitor those factors, but we need to keep moving forward. I think, through world wars, global pandemics, all of these things, investing has still worked. So whatever you're worried about right now is probably not going to dismantle the whole system. I could be wrong at some point, right? There's no guarantees, but continuously that wall has been overcome. So we're going to assume the same moving forward.
Yes.
Yep. Well, thanks, Wendy. Thanks, Pete, for joining today. On our next episode, we're going to talk about 4 things to know about Medicare open enrollment. So we can learn a little bit more prepping for that Medicare open enrollment season. Make sure that you're making the best decisions for Medicare. Until next time, remember to retire with intent so you can make the most of your hard-earned dollars.